Hello, good day. I hope you are fine. This video is about term structure of interest rate. Let's learn together. Since the outbreak of COVID-19 pandemic in early 2020, the term structure of interest rates has been unstable, with positive and inverted yield curves occur in United States. Instead, prior to the outbreak of the pandemic, especially in March 2019, the spread between 3-month and 10-year Treasury securities have already shown signs of inversion for the first time after the 2008 global financial crisis. The spread between short-term and long-term interest rates has registered a spread of negative 0.02% in March 2019. What makes long-term interest rates differ from short-term rates? What are the elements that determine the variation of interest rates over time? The purpose of this video is to help students develop a fundamental understanding of term structure of interest rates. I first introduced the concept of U-curve. This is followed by explanations on what kind of shape a U-curve can take. For a start, let's define the term structure of interest rates. The term structure of interest rates is the relationship between the rate of return and maturity for bonds with similar quality or level of risk. Term structure of interest can also be defined as the relationship between short and long-term interest rates. It is the series of interest rates ordered by term to maturity at a given time. The U-curve shows how interest rates vary between short, medium, and long-term bonds. The U-curve is a graphical depiction of the term structure of interest rates. It shows the relationship between the yield to maturity and term to maturity for bonds of the same credit quality but different maturities. Plotting the yield to maturity on the vertical axis and the time to maturity across the horizontal axis for a group of bonds of the same class will give us the yield curve. UCurve plays a crucial role in identifying the current state of an economy and provides a valuable framework for monitoring economic cycles. UCurve is also useful for forecasting, and it reflects the expectation of market participants about future changes in interest rates and their assessment of monetary policy conditions. When the U-curve shifts or changes in shape, it can be used as a leading economic indicator on where interest rates and the economy in general are headed in the future. Hassel and Lajani in year 2022 re-examined the predictive power of the yield spread across countries and over time. Using a unique data set covering 13 OECD countries over the period 1975 to 2019, they find that the yield spread signals recessions. U-curve plays a crucial role in identifying the current state of an economy and provides a valuable framework for monitoring economic cycles. is related to the price of bond, the yield curve can be used as a benchmark for the cost of funds at various maturities. When market participants refer to the yield curve, they usually mean the government treasury yield curve of a country. Because treasury securities are generally considered to be free of default risk, the treasury yield curve serves as a benchmark for pricing bonds in other sectors of the debt market. For example, corporate debts, mortgages, bank loans, etc. The yield curve may take different shapes at different points in the economic cycle. Four shapes of yield curve have been observed. The most common shape is a positively sloped yield curve, in which the longer the maturity, the higher the yield. This shape is referred to as a normal yield curve. Long-term yields are higher than short-term yields. Investors are rewarded for holding longer maturity treasuries in the form of a higher potential yield. An upward sloping yield curve signals that the economy is in an expansionary mood. A flat yield curve is one in which the yield for all maturities is approximately equal. This means the yield of a short-term bond is about the same as that of a long-term bond. A flattening of the yield curve usually occurs when there is a transition between the normal yield curve and the inverted yield curve, or the market is uncertain about the future direction of the economy. There have been times when the slope of the yield curve is negatively sloped, in which the longer the maturity, the lower the yield. This shape is referred to as an inverted yield curve. Short-term yields are higher than long-term yields. Long-term investors have the perception that interest rates will decline in the future. A downward sloping yield curve signifies that the economy is in or about to enter recessive period. A hump yield curve shows yields increasing with maturity for a range of maturities, and then the yield curve becoming inverted. This means medium-term yields are greater than both short-term yields and long-term yields. To enhance your understanding about the shape of yield curve, let me briefly explain the current state of the US economy. I hope this will help you to relate the state of the economy with the shape of the yield curve. The US economy was badly affected by the COVID-19 pandemic. At the peak of the pandemic, the GDP of US recorded a severe contraction of -9% in the second quarter of 2020. By the first quarter of 2021, the economy started to recover. Amidst the COVID-19 pandemic, the US Federal Reserve cut the federal funds rate by 1.5 percentage points on March 3rd and March 15, 2020, to support spending by lowering the cost of borrowing for households and businesses. This cut lowered the fund rate to a range of 0% to 0.25%. This move had implications on short-term and long-term rates. As a result, yield curve shifted down. How is the shape of the yield curve after the outbreak of the COVID-19 pandemic? This figure gives a visual presentation of how the shape of U-curve have changed for the sample period of 2019 to 2022. The recent yield curve in April 2022 has a positive slope, but flattens off at 10-year maturity. Drawing from the conclusion in this video, the yield curve shows that the US economy is recovering. An upward sloping yield curve signals that the economy is in an expansionary mood, but there is still sign of uncertainty. The long-term rates have increased during the second half of 2020, indicating investors are compensated with higher liquidity and risk premium for holding long-term bonds. Investors are rewarded for holding longer maturity treasuries in the form of a higher potential yield. The pattern of the yield curve reveals that the worst is over after a 2-year fight against the pandemic. With the vaccination of the population and the reopening of various economic sectors. For further reading on the content of this video, you may refer to my recent article published in the CFA Asia Pacific Research Exchange. You may follow the link listed on the page of this video. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.